Welcome to the latest edition of Fundamentals. This time around, I'm going to look at an actively managed member of our list of 72 favourite funds, namely Janus Henderson UK Property Fund. Now, the fund's objective is to provide a high income for investors and also add in some growth in both income and capital. The fund is a PAIF, P-A-I-F, Property Authorised Investment Fund. This means it's a tax-efficient vehicle that is permitted to pay out dividends from its property rental income without any deductions for corporation tax. Now that helps to boost the yield available to investors in the £3 billion fund, which, as its name rather suggests, invests primarily in commercial property and property-related assets here in the United Kingdom. Lead managers Ainsley McLennan and Marcus Langlands Pearce look to cater to the income and capital needs of their investors by managing the fund with a long-term focus to generate reliable income from a portfolio of good quality properties that are occupied by financially sound tenants. Ainsley McLennan's got more than 20 years of experience of the property markets and joined what was Henderson in 2002, while her colleague Marcus Langlands Pearce has covered property since 1991 and joined his current firm in 2009. The fund offers property to 85 separate sites with 593 tenancies across primarily England, but also with Scottish and Welsh exposure. The fund's nicely diversified by sector as well as geography, with retail the largest exposure and a relatively modest presence in offices. The largest individual tenants by income include the London Fire Brigade, the do-it-yourself retailer B&Q, Asda, drinks distribution specialist Kuehne + Nagel, and also grocery giant Sainsbury. The top 10 individual properties, well, they include a business park in Hertfordshire, the London Fire Brigade's office in SE1 London, a logistics and warehousing site in Derby, a shopping park in Wigan, and a data centre in Romford. Do note that Janus Henderson UK Property does not own just property. As we can see from the asset allocation here, about 4.5% of the assets are in quoted real estate investment trusts, property stocks, and nearly 19% in cash. Now these portions of the portfolio are there in case investors want their money back in a hurry, and they're thus a source of ready liquidity. After all, the fund managers can't sell, or for that matter buy, buildings at the drop of a hat. Now we come to the yield on offer, and that's currently around 2.2%, and it comes from the rent paid by the tenants. We're talking about the accumulation units of the fund here, so the dividends that are due on a quarterly basis at the end of every January, April, July and October, they will be automatically reinvested for you. The fund comes with an ongoing charge figure of 1.65%, so you do have to pay for the manager's expertise, and for those who put faith in such things, it doesn't have a star ranking from Morningstar, although I should say that that's the case for all of the funds in the UK Direct Property Fund category. As a final point, Janus Henderson UK Property PAIF is eligible for SIPs, ISAs and dealing accounts, and the minimum investment is just one share, and they cost around 141 pence a piece as I sit here right now. So, those are the mechanics. The question to address next is why could investors consider this fund for portfolio inclusion today? And I think there are three perfectly possible reasons. The first is that exposure to property can provide some portfolio diversification. In addition, the portfolio itself is well spread since it's not unduly exposed to the City of London, new office development or any of the other parts of commercial property which is seen as at risk because of Brexit or wider uncertainty over the UK economy. The second reason is rental income generated by the properties in the fund's portfolio, which turns into that 2.2% yield. And the third reason is healthy capital returns provided by the fund since its launch, which have generally supplemented the income on offer. Now, UK property has tended to rise in value over time as the country offers rule of law, an independent central bank and one of the world's 10 biggest economies, so it's an asset class that has tended to attract overseas buyers, which in theory it could do again with the pound trading at depressed levels right now. However, we must always remember that past performance is no guarantee for the future, and the Janus Henderson UK Property PAIF may not therefore be suitable for all investors, also for three perfectly possible reasons. The first is that property is truly a long-term investment. Although the fund does hold cash and property stocks to try and provide liquidity if you want your money out in a hurry for any reason, as let's face it, some people did straight after the e-referendum in 2016, that's not really the point. And it's still not easy for the fund managers to help you if you do want to get out in a hurry. This is a fund that is truly best suited to very, very patient investors. The second reason, well, that's the 2.2% yield may actually not be enough for some income seekers. After all, inflation's 2.4% and the FTSE 100 share index comes with a dividend yield near 4%, although you could argue there may be greater capital risk there, depending on your viewpoint. And the third reason is that, well, interest rates could, one day, go up again. I know they're just 0.5% right now, but if the Bank of England ever sees the need to increase headline interest rates, that will increase returns on cash, and they may lure investors away from property and back to cash. That could decrease the relative attraction of property or even persuade some investors to sell their property exposure. And, as we saw from the fund's performance chart a moment ago, the fund's value can go down as well as up, and it did fall sharply, if briefly, in the wake of the Brexit vote 2 years ago. What all of this goes to show is that investors must therefore do their research on Janus Henderson UK Property PAIF to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work and indeed at risk. Thank you for watching, and I look forward to seeing you next time.